And of course, these inflation concerns coming at a time when we're seeing markets across Asia really feeling the pain. This GTV chart on the Bloomberg showing markets entering correction, bear market, and so forth. Really, that chart not looking pretty. Where do you go to take cover?
Well, obviously, there have been a bit of pressures, and not only over the last 12 months, but also since the start of the year, especially in the last few sessions. Despite the correction, however, if you look at the overall Asia index, it's actually doing better than the U.S. equities, at least as far as this year is concerned. And for us, that's an interesting signal. Obviously, last year there was a combination of pretty, difficult market environment for China, and there was not a full reopening of South Asian economies, and that these two kind of trends combined together to produce a pretty mixed year, maybe except for Taiwan and India. However, this year, at least the relative performance so far is a bit more encouraging. And policy in China is turning in the right direction, and South Asia will likely enjoy much better GDP growth this year compared to last year, due to improving public health conditions. So we do have this Fed story in the background. There will be a source of volatility in the very near term for sure. But over the longer term, by the end of this year, we still think the indices will end up higher, and we are constructive on the recovery prospect from here.
Is that also because you're seeing a larger valuation cushion in Asian economies, in Asian markets?
Absolutely. I mean, the regions index usually has a bit of discount to the U.S. equities, but that discount has widened quite significantly over the last 12 months, and remains quite compelling. So if you look at the indices, for instance, H shares, roughly about 40% discount now. Korean market is now just about half in terms of next 12 months forward earnings multiple compared to the U.S. And the other regions also see roughly about 20% discount, with the exception of India. So our thinking here is that given the transition that we're seeing in the markets, and the positioning, the macroeconomic fundamental, and the positioning of these markets, we think there is sufficient valuation cushion here that should give investors a bit of comfort as we navigate this environment.
We do also have an environment of a strengthening US dollar, though. Does that alter your thinking around emerging market opportunities?
So the first half of this year will be a difficult kind of a navigation work for investors in the region and including the broader emerging market, because we're still dealing with some vague elements of the guidance from the Fed that will have to be clarified. So our kind of strategy at the start of the year is to focus on the Asia opportunity set, because that's a set that's more stable compared to the rest of the emerging markets for sure. But in the second half of the year, the picture could be quite different. If you think about the political development in the U.S., it will likely that it's quite likely that we'll get a gridlock in Washington D.C., and that will make the policy more difficult going forward. And that's not particularly a dollar supportive environment there. And emerging markets as a whole, we continue to see improvement in vaccinations and in public health conditions. So second half of the year, the emerging market as a whole will be a very interesting investment call. And we do think there will at least be a tactical opportunity for investors to consider at some point in the middle of the year.
Mm-hmm. We've seen the Bloomberg Commodities Index surging for 6 weeks in a row now. How are you trading around this? How long do you see that lasting?
Obviously, given the geopolitical sources of this new trend here, as well as the underlying fragility in the energy market, it's something that we need to continue to monitor. Our thinking here is that if we somehow avoid an incredibly disruptive conflict, around Ukraine, and that will likely lead to kind of a more stabilization of the commodity price in the remainder of the year. Certainly it deserves a bit of, it requires a bit of cyclical exposure in your portfolios to navigate the environment well. So our thinking for the commodity complex, there's some upside for the energy prices, especially for gas and food prices, maybe in the first half of the year. If the policy tightening that we see from a bunch of different central banks materialize, then we'll likely see this complex maybe stabilizing by the end of this year, and that should be a neutral kind of development for global equity markets.